Welcome back, everyone. And today we have a treat for you. What I mean by that, because you are going to hear it's a masterclass on tax strategies for real estate investors. Welcome back, everyone. My name is Si-Wing Yi from the Real Estate Network, and my co-host once again is Julie. How are you, Julie?
Good morning, fine, Wing. How are you this morning?
Yeah, fine. Thank you, Julie. And Julie is one of my top real estate investor within my investment club, if you will. And she have purchased multiple turnkey properties, cash flow, out of state. Several years ago, she have scaled her portfolio mightily, and she's learning. She's going through this process. I invited her because she loved learning. Julie, as a successful real estate investor, she practiced daily discipline. What that mean, daily discipline? You're still learning. You never stop learning. There's always things you do not know. You're going through the journey of scaling your real estate portfolio and learning, educating yourself so you can empower yourself and others within your community.
Absolutely. Thank you.
Without further ado, let me share my screen and we can have a real good treat because hopefully you're going to love this. We'll see. Let's dive into amazing tax strategies for real estate investors. This is Real Estate Masterclass. And the disclaimer, Julie and I, we are not licensed tax advisors. This is purely educational content. Please consult your own financial and tax and legal advisors based on your own unique situations, strategies, and goals. By the way, another value that Julie can add to our joint podcast over the past few years when we're doing this kind of video, Julie, you have a good understanding of tax strategies. As a real estate investor in a couple of your properties, you use a self-directed IRA to buy rental property. So you have a little bit of training from your past career about real estate taxation. Yeah. So hopefully this information going to resonate with you as I hope it's going to resonate with the rest of my listeners out there. So
Absolutely.
First and foremost, I know we're going to focus on taxation on real estate, but at the end of the day, we buy rental properties to create wealth, to create long-term wealth and income property, rental property. As you can see right here, Julie, you and I spoke about it, this topic many times over the years, and I have to reiterate that the attributes of rental property are not just cash flow, because on a historical basis, real estate asset class, income property is the most powerful and proven multi-dimensional real estate asset class, is the most tax favored asset class in the history of the world. And a lot of newbies and even a lot of experiencing investors, in their mind, just because somebody bought one or two or three rental properties in the past few years does not make them a savvy real estate investor. They could as well be newbie, as far as I'm concerned. I'm sure you'll agree, Julie.
Absolutely.
Because we have so many newbie investors, rookie investors, and the so-called experienced investors are still sitting on the sideline, okay, waiting for whatever excuses to happen. So they stay on the sideline. You know what's happening with people who stay on the sideline? Look at at least 4 dimensions of profit areas they are missing by instead of buy real estate and wait to buy real estate. They're missing positive cash flow at 25% down payment typically. They're missing tax benefit, which we'll dive into it. They just don't know. By the time you and I finish this tax presentation, people would be shocked. There's so much tax benefit real estate investors are missing. So cash flow, tax benefit, appreciation, long-term appreciation, right? And the power of using a 30-year fixed rate mortgage, the power of leverage. So this high level strategy alone will make somebody very wealthy long term if they do things right. So what are your quick comment on this particular great high level concept?
It's interesting. I think as a relatively newbie investor, but somewhat seasoned investor, because we were able to purchase 6 properties. Initially, my husband, I think like many people getting into the business, you only look at the cash flow because it's about, if I'm going to buy this, it should make money, right? Yeah, that is one aspect of it, being able to make money. But then since we've been able to have the properties for a few years now, we do understand the tax benefits, the short-term and long-term tax benefits, the appreciation, even though we've only had our properties for about 3 years at the moment. Yeah, because we started investing in early 2001. We have experienced appreciation on all of our properties, and our properties are not in a high appreciation area. But we have been able to benefit from that. And then, yeah, the power of the 30-year fixed mortgage allowed us to buy more properties than we would have had we chosen to pay cash outright, and then all the benefits that come with that. Yeah, those are four great strategies for why some would want to get into investing in property.
Yeah, again, so people need to have a high level, big picture perspective. They have to look at 5 to 10
Right.
year projection. So if you don't have this software, I use property tracker software, and you too as well.
Yes.
People focus on the first year return too much. Oh, little cash flow. But if you look at this pro forma, if you look at this sample real property that were in Florida, for example, the single family home, new construction, sell it for 264. I'm not going to go through the numbers that much. At the end of the day, it's a positive cash flow of $300 net positive per month. Okay. I'm not going to go over the metrics and all that,
Right.
but this is just a first year projection. Now, the beauty of owning property long term is this. I'm just showing the 5 years of return. Again,
Right.
I'll be real quick about it. So if any investor, they need to look at deep dive. The first few years, they may not get the immediate above the surface benefit.
Right.
Above the surface, we talk about, you and I, above and below the surface. Above
There
is
you go.
above benefit that we can see is cash flow and appreciation, and below the surface or the amazing tax benefit, which we can talk about, as well as in the loan amortization, paying down the mortgage, the tenant that is going to pay down, our tenant is going to pay down our mortgage as landlord. And if you quickly, again, I don't want to spend too much time on this because we have done other videos.
Right.
We talked about this. With the inflation, going to help landlords. The inflation going to help investors to create wealth. One of the way the inflation is going to help is rent. We can raise our rent on a systematic basis. May not be year over year. It depends. 3 to 5% will be a good historical rental rate, because with rent inflation, us landlord can benefit because we can raise our rent from month to month, year to year. As you can see, this is just a projection. Year over year, our gross rent is going to be higher. That means the low cash flow we're getting in this particular example, a mere $300 per month. Yeah, that's not going to change your financial life short term. This $300 positive cash flow, sometimes things happen and you may not you may not benefit from it. But the key,
Right.
so don't worry about this low cash flow initially, because again, if you keep this property long term for 5 to 10 years, your cash flow will increase, as you can see right here.
Absolutely.
Furthermore, okay, the expenses, they will go up by inflation also, but at the same time, if you look at the income analysis, we look at our amazing 30-year fixed rate debt, which is amazing. It is the eighth wonder of the world. Yeah, the cash flow going to go up, and then the principal reduction. We talk about loan amortization. The tenant, each time the tenant make our monthly rent, they can pay down our mortgage, pay down our loan balance. As you can see, the principal reduction keep on going lower, and principal reduction will give us a tax benefit. And then the 5% appreciation. Appreciation is very important when you buy in a good location in a fast-growing area. In this case, look at 5 to 8% appreciation. The first year, the property already appreciated 22 grand. Then year over year, some year you may not, and the property may not appreciate. We get that, right? There are some fluctuations, as we have seen in the past couple of years. There's a lot of fluctuations going on in the housing market. But over time, look at the appreciation. It continue to increase, okay? And then, under the loan analysis, so when your property increase in equity year over year, hopefully, you bought it in this case for 264. Second year, third year, fourth year, fifth year, based on 5% appreciation, whatever. Look at the market value of your property long term. And then the loan balance, continue to decrease.
Right. Absolutely.
Amazing, right? The tenant is paying down our loan for us as landlord. The loan balance decrease, the market value increase over time. Then systematically, you have year over year equity continue to grow. As you can see, the numbers grow amount of equity on just one property. And then if you want to, one of the extra strategies, you can cash out refinance some of the equity based on the loan to value. As you can see right here, you can cash out refinance, which is a tax-free loan against your property. Cash out refinance, that's the whole idea. This potential equity you can cash out at any given year in the subsequent years allow you to leverage to buy more rental properties and scale the portfolio so you can achieve financial freedom at some point in time in the future, right? And
absolutely, that makes a lot of sense. Definitely.
So any quick comment on this 5-year projection and the high level?
Yeah, I think it is. I think what you said, it's a 5-year projection, or it's a long-term strategy. That's actually a relatively short period of time, 5 years, but you can see the benefit of holding on to it. And if you scaled that out to 10 years, 15, 20 years, exponentially, the benefits are going to grow. Your equity is going to grow. The loan is going to decrease. You still have the tenants paying the mortgage, and your cash flow overall is going to increase the longer you have it. So it makes a lot of sense. But I think that when people are looking at doing an investment, you have to look at the long term as well as the short term. I think most people only want to look at, oh, am I going to make any money this year? But it's like you're talking about something, an asset that you can have virtually for a lifetime, and it will continue to pay you money.
Yep. So to conclude this graphic and the previous 2 slides, at the end of the day, the winners are the landlords and investors like you and I continue to buy cash flow properties and hold over time. And the losers are sitting on the sideline doing nothing, and they're foregoing all these 5 dimensions of profit center on a particular income property. So you know who you are out there. There's no reason to wait. Buy in the right market. Surround yourself with a good team. Buy cash flow markets. Surround yourself with great property managers and so forth and so on. So sitting on a sideline, it'll be a detriment to your financial health.
Absolutely.
One of the tax strategies we could talk about is short-term rental tax loophole. The average rent for your short-term rental, Airbnb, whatever, is average stay is less than 7 days. And if you material participate your short-term rental, meaning you are putting in more hours than anybody else, at least 100 hours or more based on the IRS rules. Material participation means you have to get your hands dirty, you have to self-manage, you have to do all the real estate activities, just like running a business. So that's the material participation rule is very stringent, okay? So if you hire a professional property manager to manage your short-term rental, you are not materially participating. Short-term tax loophole, I hate to use the word loophole. It's not really a loophole. It's a legal tax strategy. If used correctly, you can achieve massive amount of profits, not only short-term cash flow and all that, but tremendous tax benefit, because short-term tax loophole give you a special tax write-off that a long-term passive investors may not get. Short-term rental is an active business. You are in the hospitality business. It's just like running a real business, a brick and mortar, running like a retail store, running a hotel. You are getting down and dirty, because short-term rental by IRS definition is an active business. It's no longer passive rental real estate. So my long-term properties, your long-term properties are managed by property managers. By IRS definition, we are a passive investor. We get some limited write-off. Our passive losses cannot exceed our passive income. That's a limitation. But anyway, filing tax return as a short-term rental landlord, you can file your tax return on Schedule E, which is typical, but you can also create some LLC or S corporation with respect to your short-term rental. So those are rules. The short-term rental loopholes, if you will, is a way to reduce taxes from your W-2 income without having to qualify as a real estate professional reps status, which you and I will talk about it later on this presentation. It works like this. You save enough down payment, you buy whatever short-term rental property somewhere in the US, then you buy it, then you convert it into Airbnb, Verbal, whatever. Make sure the average stay is 7 days or less. And you have to material participate. Usually you're going to self-manage.
Right.
You have to understand this. Do you have the mindset and the skill set to run a hotel business?
Right.
Are you willing to spend a lot of time, extra time? You know, if you have a regular full-time job, 40 hours a week, W-2,
right.
If your property is located out of state or long distance, 1,000 miles away, you have to question yourself whether you want to become a
serial participant. Yeah.
Yeah. So each investor, they have to ask themselves, what is their skill set? Are they willing
Right.
to get down in dirty blood and sweat and tear, get the tax benefit, the short-term rental tax benefit for the sake of that, and spend the effort personally? Given my stage of my investing career, I'm not going to go back. I'm not going to get down and dirty to
Right.
self-manage. That's too much work.
Right.
My
It is a
time.
lot of work. It's a lot of work. And I think I always think about when that plumbing breaks at 3 a.m, they'll be calling you. There are definite tax benefits to doing that, but just understand it's really your time is not your own because you're really at the mercy of whatever tenant is participating for that 7 days or less. Yeah.
Yeah, exactly. Yeah, but for those people that have the mindset, have the skill set, or willing to do it, willing to put in the effort, even though they have a full-time job or whatever, by all means, persons have a different skill set, a different buy box, if you will, right? The word buy box. There's so many ways to make money in real estate, so you have to find your niche. You have to find something you feel good about, something you have the skill set. It all depends, right? So anyway. So if you're able to do a short-term tax loophole, you can do cost segregation, you can do bonus depreciation on top of all the paper losses, past losses from your short-term rental. You can also you can create large paper depreciation deductions. You can offset those deductions to against active income, bypass the passive activity rules.
Right.
Imagine if you have a fairly high income, if you have mid six figure in W-2 income, you have a top federal marginal tax rate and high state tax rate on top of that. Imagine if you could do a short-term rental tax loophole and get the bonus depreciation conjugation on top and depreciation everything in the current year. If you're able to buy more than one short-term rental, whatever.
Right.
I do not own any short-term rental, neither do you. For past 20 years, I only own long-term rental, and I use property managers to run all my rentals over the years, and many hundreds of our investors that I consult with, that I got with over the years, including yourself, whether you have 5 long-term cash flow rentals spread across different regions of the U.S. or not, whether you have 10, whether you have 15, whether you have 20, by using our turnkey professionally managed portfolios, typically on an average month. Julie, I'm going to ask you this question before we move on with the other tax strategies. On an average month, on your massive portfolio you currently own, and my other investors own similarly 10, 20. Some of our investors over the years that we work with already own 10, 20, 30 or more
Nice.
rental properties, single family homes, duplex, triplex, and fourplex. And the average with the turnkey approach, professional management and all that, what is the average monthly, how many hours you put in to quote unquote manage your massive real estate portfolio?
Right.
Monthly. How many hours?
I would say less than an hour. I've gotten it down pretty skilled now. Like I said, we have the 6 properties. We get the rents in once a month. The logging in the paperwork, basically, so to speak, into our computer system so that we'll have all of that information at the end of the year when we file our taxes. It takes me less than an hour now for 6 properties. Yeah. So it's very low maintenance. I say this every time. I forget that I own property until that check rolls in on the 15th of the month. And then I realize, oh yeah, I have property. So it's very passive.
Julie, I bet you spend more time collecting your multiple checks per month than actual time managing your real estate portfolio.
With the onset of electronic deposit, virtually no time doing that. Like I said, I see the bank statement. Okay, cool. We got it.
Actually, we spend more time in between tenants. When a tenant leaves,
Right.
The vacancy, the couple of weeks or maybe 1 month or longer, or vacancy between getting a new tenant and fixing up the property, those time could take 1 or 2 hours when there's a changeover of tenants. If all our real estate portfolio, if our tenants does not leave, and many of our tenants, they stay 2 or 3, 4 years at a time. Imagine that.
Right. No, it's great. And like I said, we've had the shorter time maybe than some of your other investor clients have had, but we've only had 2 clients move. And so the other 4 have been very stable, very consistent, same tenants, pay every month. So yeah, it's been a blessing to be able to count on those long-term tenant stays.
Yep. Okay. So having said that, yeah, I know I'm all in. I'm not saying don't do a short-term rental, but
Right.
in fact, if you have a 10, 20-year investment horizon, if you have sufficient capital, I encourage you to do at least one short-term rental, whether you're going to qualify for the tax loophole or not. Sometimes, look, Julie, short-term rental, some people don't care about the tax benefit with the tax loophole that
Right.
we discussed, but it's okay. If they can convert, they can use a short-term rental to pivot into a medium-term rental. We talk about it, even to a short-term rental. So you could, if you have an income property located at a particular location, you can pivot between long-term, medium-term, and short-term, and
Absolutely.
do that, right? And don't even worry about the short-term tax loophole,
Right.
because that's the beauty of owning a rental property.
There you go. Nice. Very
Yeah.
nice.
Let's move on to another strategy. Let's get back to our passive loss limitations. Okay, so let's use a case study. Someone, a taxpayer, investor, making $100,000 or less. Okay, not more than 150K. Okay, let's look at the IRS active investor rule. Okay, adjusted gross income of, let's say, 100 grand. Well, most of our investors located in California, they make a lot more than $100,000 a year. Okay, but
Right.
some make less than 100 grand. We have members who live outside California, right? I have members within my investment club who some live in Arizona, some live in Texas, some live in Florida, some live in the East Coast. Yeah, I would say 80% of my investment network members live in California. I live in San Francisco Bay Area for the past 30 years, which is one of the highest cost of living area in the world for that matter. So that's why you and I invest out of state.
Exactly. I was going to say that's why 80% of your clients are in California because it's too expensive to invest here. So we have to go out of state to do that.
Absolutely. Absolutely. Yeah, I've been doing it for 20 years. So I've been there, done that. I see a lot of new flavors of real estate come and go, but my investment methodology have not changed for 20 years. Buy turnkey properties out of state with professional management and long distance remotely, and let everybody else do the dirty work for you, so you can grow your portfolio, so you can free up time to travel, to do whatever is important to you, and not get bogged down for those daily aspects of self-management, which is whatever. Okay, the problem is, getting back to the tax rule, Section 469 of the IRS tax code limits losses from passive activities from offsetting non-passive income. So again, our income property, which is fine, even though you and I are not getting special tax benefit, at least we're getting all the other dimensions, cash flow appreciation and whatever, which we just talked about. By definition, long-term investors using professional management, you and I, any kind of depreciation or paper loss can only offset by the passive income, by the rental income limitation that we collect. So we cannot use our depreciation passive losses as passive real estate investors against W-2, which is non-passive, which is active income. So far, so good?
Yes.
Yeah. The exception is you qualify for reps. Reps, be prepared to bring this acronym into your terminology. Reps means real estate professional status, which we will talk about toward the back end of this video presentation. But people think, oh, this professional status, you must be a real estate agent, you must be a realtor. No, you don't have. With a professional status is a IRS definition. It's not a real estate definition. Okay, you don't have to be a licensed realtor. You don't have to become a real estate investor. You don't have to be whatever. We'll talk about more about that. So full-time employees and full-time business owners cannot qualify as a real estate professional because one of the qualifications is spend more time in real estate than anything else. Anyway, we'll talk more about that later on. Okay, let's continue. So here's the passive loss limitation. Julie, I'm sure in your past, you learned something about this, right? When you were in the business of real estate years ago. So, yeah, so passive loss allowance, again, if you make $100,000 just gross income, you could only reduce your debt service expenses from your rental property and any depreciation you get up to the maximum of $25,000, which is my deal, But Again, later on, we could talk about briefly the realistic professional status. You get unlimited write-off. That's the key. Which is
Right.
not too many people are willing and are able to qualify as a realistic professional
Right.
status. Again, we'll talk more about that later. But it's okay because if you make less than 100 grand, you can deduct up to $25,000 property, the passive losses, paper losses against your active income. Yeah. So 25,000. So if you do use a straight line, 27.5 year annual depreciation on a property, like $200,000 property, for example, that you and I buy, $200,000 per property divided by 27.5 year, which is the depreciation method. So the annual depreciation is probably like 5,000. So if you buy five $200,000 long-term rental properties at $5,000 annual paper depreciation loss based on this rule, so basically 5 rental properties of a 200 grand pretty much max you at the $25,000 passive loss depreciation limitation.
I see.
Under this category. So far, so good.
That makes sense.
Good thing about it, people, when people watch this video and they can archive this video, they can always replay any of the words that come out of my mouth. Okay. And you may not be able to digest any of this presentation immediately. But the beauty of having this video available for future purposes, you can replay the video, whatever areas of this video that you need to further understand.
Sure, absolutely.
Anyway, so the next level of passive loss allowance limitation are people that make more than 100 grand, but less than $150,000 adjusted gross income. As a passive realistic investor, most of us are, you get no current year deduction. All the depreciation and passive losses have to be suspended indefinitely for future years to offset against future passive income. Does it make sense so far?
Yes, I understand what you're saying. Okay.
Yeah. But then again, some people, like most of our investors, Julie, are from California. They make way more than 150K. So one would think that, oh, I should not buy real estate because I'm not getting any current year depreciation deduction to offset my passive, my rental income. That is a very limited belief, which is uncalled for. So let's get educated. I'm gonna prove the point that you can still buy income property regardless of the tax benefit, because your primary goal is to get cash flow and appreciation and loan pay down. And now you're
right.
All right. Now the key is, if you make more than 150K, great. You pay a lot of taxes, great. If you make 300K, 500, $500,000, stay tuned to the back end of this presentation. I'm going to blow your mind with the huge tax benefits if you qualify. Julie?
Okay, that sounds good.
So 150K or higher, you have to, any depreciation you could potentially claim or carry forward in the future years, suspension of passive losses. You're going to accumulate a lot of passive losses into the future years to potentially have a future tax benefit. If you make a lot of money per these limitations, it's okay. It's okay to, because your future suspended accumulation of passive losses, depreciation, you cannot get on the current year. That's a future benefit. So keep that in mind, especially when you're a long-term risk investor. So those benefits will come back to you. Okay.
That makes sense.
Yeah. Don't fear. All right. Let's go on. Yeah. Okay. This slide should pretty much talk about the passive loss limitation. Do you have any questions about the passive loss limitation? Any quick comment, Julie?
It makes a lot of sense. But again, I think it's just looking at this whole concept as a long-term strategy, not looking to get all the benefits today or within the first year. So yeah, that does make a lot of sense to understand that at some point in the future, you'll be able to take advantage of those losses, those passive losses.
Absolutely. Yeah. Especially when you sell, if you were to sell some of the property in the future, some of your rentals in the future, any capital gains you could trigger can be offset by those accumulation of suspended past losses.
That's good to know.
Whereby your capital gains is potentially substantially reduced or even eliminated. Whereas you do not need to do a 1031 taxable exchange.
Oh, that is good to know. I don't think I realized that. I thought you always had to do a 1031 exchange in order to avoid that tax
No, not at all.
liability. Oh, wow. That is good to know.
That's one tax tip you just learned, Julie.
I did. That's very important.
If I were to tell you, a lot of investors I come across over my several decades of real estate consulting, that a lot of investors who've been investing for 5, 10, 15 years, a lot of the tax strategies we are discussing today, they are not totally aware.
That's a good piece. I didn't know that. Yeah.
They don't know. They still don't know.
Mm-hmm.
They
Mm-hmm.
see, you think a savvy investor who bought 2 or 3 rental properties for the past 5 years, you think they know it all?
Probably not. Definitely not.
They do not know at all. In fact, they know a lot less than they lead out to believe.
There you go. Mm-hmm.
Why? Because I consult with those individuals on a daily, weekly, monthly basis. I've helped so many hundreds and even thousands of real estate investors. And I know the challenges they're facing. They don't know it all. In fact, they know a lot less. I think they know.
Yeah, exactly. That's interesting.
That's right. I'm telling you from real experience. We're going to use this pro forma template to do the numbers. So this property is a property that we promote in South Texas. This 4-plex new construction, this 4-unit, the duplex quad, 4-plex, 45K. I'm not going to go over the numbers, but this is a great cash flow property, good rent to value ratio, the whole 9 yards. So we're going to use this as a template to go over the case study of various tax strategies. Okay. Keep that in mind. This is the benchmark we're using. We could be using any type of property. Doesn't have to be 4-plex. It could be a duplex, could be a triplex, could be a single family home unit. So just bear in mind, this is the template we're using. So let's calculate regular depreciation. Okay. This property, 545K, you minus the land's not depreciable. Let's say 20% of your property is land. So you have to take out the land out of it. So your basis for depreciation, your cost basis, if you will, is 436,000. So far, so good?
You're right. That makes sense. Yes.
Yeah. Most people, even so-called savvy real estate investors, they think the only way you can capture the paper loss to reduce the gross rental income on each property, or the straight line depreciation for 1 to 4 unit, which is 27. You depreciate little by little over 27 and a half years on a residential income property. On a commercial 5-unit or above, the depreciation straight line schedule is 39 years. All right. So far, so
okay. Yes, that makes sense.
Yeah. So on this 4-plex, so 436 divided by 27 and a half years. So your annual depreciation, your paper loss that the tax code allow you to achieve to reduce your income subject to taxation is almost 16 grand. So that's a nice benefit just from one 4-plex for 545K, right?
That's it. That's nice. Yeah, definitely.
Yeah, that's really nice. Using, like I said, you could file on a Schedule E, okay, supplemental income schedule. Regular straight line 27 and a half year depreciation schedule. And I took the liberty of doing this is the Schedule E, right? Income and loss, Schedule E from 1040. So this is the gross rental income on that 4-plex, right? So even you can still, if you cannot get the depreciation because you make more than 150K, you can still deduct all this. You can still deduct all this debt service and all these monthly and annual expenses from the gross income. Because Julie, the gross is 64,000. You're collecting the rent for the year on this 4-plex.
That's right. That's right.
If you do not take any deduction, any of these underlying deductions down here, the 64,800 is taxed at the ordinary tax bracket.
Okay.
Ordinary tax bracket, which is if in the upper end of your tax bracket at whatever, the federal tax bracket like 37%, right? Imagine if you make 400K, 500K W2 income, 64,000. If you ignore all these expenses down here,
right,
you have to pay 37 federal and maybe 13% state income tax in California or New York State.
Yes.
Half of this $64,000 will be the IRS can collect half of it.
Yes.
Okay.
They sure are.
you are a smart investor. You watch our video. You watch this particular video. So you take your regular debt service expenses, advertising, travel expenses, cleaning and maintenance, your insurance you pay on your rental property, your property management fee, and this annual amount, all this annual, by the way, the mortgage interest you pay on income property, all deductible against the rental income, against the
Right.
gross rent,
Right.
right? And so on. And then on top of that, based on the prior example, you on this fourplex, you're getting almost $16,000 of paper loss
Mhm.
for the year-over-year basis for the next 27.5 years.
Right.
Therefore, so your total expenses on this one property, this quad, is $76,000 already, and your rent for the year is $64,000. But on the real aspect is you get cash flow, right?
Oh, absolutely.
The cash flow, the reality purposes, you're collecting cash flow, which is right here. Your monthly
Right.
cash flow is $773.
Almost $800 a month.
Your annual net cash flow almost 10 grand, right?
That's a good deal.
So in reality, you are making money just
Absolutely.
based on cash flow, but you're making money on appreciation also, which is not taxable because you're not selling your property.
Right.
So this is a unrealized equity gain year over year based on the projected first year appreciation and beyond, right?
Absolutely. Oh, that's
So-
fabulous.
so-
That's a
so-
great property.
Yeah, in reality, you're making 10 grand net annual cash flow. And yet on paper, because you understand tax strategies and all that, on paper, you show a loss. You show a paper loss, right?
Right.
76,000. So 64,000 gross annual rent on this one property, minus 76,000 of all the deductions and depreciation and all that equals your paper loss of almost $12,000.
Right.
On paper, when
Yes.
you file your federal tax return the following April 15th or beyond, if you're doing an extension, this 11,922 on just one property can reduce your adjusted gross income accordingly. So if you think about it, Julie, if your adjusted gross income, let's say 100 grand, okay, with this deduction of paper passive loss was almost 12 grand. Are you paying taxes on 100 grand or you paying taxes on $89,000? So this deduction will give you a lot of tax benefit. Okay.
Absolutely.
Yeah.
It's amazing.
Yeah. We could talk cost segregation later. We could, and we could talk real estate professionals tax status later on this presentation. Okay. So far, so good.
No, this is great. This is really good information.
Am I explaining this in a layman's way where you truly
Absolutely. I don't do my own taxes, but it's really simple. When you look at it on the paper, you can definitely see the advantage. And I think the point that you made is you are still collecting the rent, which is giving you cash flow. But then on paper, then you have these losses that can be carried out through the years. So it's a great strategy.
Amazing. And 5 ways to make money in real estate and tax benefit is just one of 5 ways. Is it amazing?
Yes, it really is.
People who qualify, people who have good credit, people who have down payment, who have the capital to invest, what in the world would not buy income property because it just mind boggle me why people have this analysis paralysis scenario and stay on the sideline.
I think not enough information and fear. I think fear gets in the way of people making decisions. But when you have the information and you want to do it, then it's time to start moving.
Okay, Julie, let's talk about not enough information. At least people are in my network, right? There's several thousand members in my network. And you get my daily email, free educational contents, all aspects of this investing. If you are getting my daily video newsletters, and several thousand of my members are getting the same daily information about all aspects of risk investing, including this video. You cannot say they're not getting adequate education.
Yeah, that's a very good point. You're absolutely right. I think it's maybe then gets back to get past your fear and then just make a decision.
Yeah. So the fact my members, I can't speak of other investors out there that I do not know about, but at least within my network, I feel I overdo in providing amazing educational contents on a daily basis.
Right. Yes, you are very consistent about that. So yeah, there is definitely enough information out there.
This lame excuse for anybody for my network, especially my members, said, "Oh, I'm not getting educated. I'm not getting enough real estate education." For someone to say that, they are just delusional. Delusional.
With the invention of Google, there is more than enough information out there. You're absolutely right.
Yeah,
What you're doing every
yeah.
day.
Not just my content for my investment club members, free members, by the way. Feel free to join. If you have not joined, put your email on my website below so you can become a free member of my organization. So anyway, you and I have done so many of these podcasts about all aspects of real estate. And for anybody have an excuse for saying that they're not being informed, they don't have enough real estate, I say, go look yourself in the mirror. You have an opportunity on a daily, to practice daily discipline, to click my video and watch, spend 20 minutes per day out of the 24 hours you have per day to watch our content. And it'll inspire you, it'll motivate you, it'll educate you, it'll inform you to take action. Right?
Absolutely. You're absolutely right.
Everybody have 24 hours in a day.
That's true.
They can allocate and prioritize 20 minutes of their time to watch my video newsletters on a daily basis. Every single tile kickers, every single year, they stick on the sideline. They come up with some kind of excuses. Year over year for the past 20 years, a lot of my investors that I know that they've been part of my membership for the past 5, 10, 15, 20 years, they have done nothing.
Oh my goodness.
Nothing. They watch my contents from time to time, my newsletters. At the end of the day, analysis, paralysis, they stay on the sideline.
That's it.
Come up with all kind of excuses. I'm waiting for the perfect time. I'm waiting for the housing market to crash 50% or higher. I'm waiting for the mortgage interest rate to come down to 2% before I buy.
Don't keep waiting for that.
We can talk all day about this, about the emotional, fragile mindset of rookie investors, but I'm not going to go there. Let's go over cost segregation. Earlier, we talked about straight line depreciation, which some people more knows about it, but a lot of people don't know about the benefit of cost segregation. So cost segregation, you can accelerate depreciation instead of doing annual little depreciation deduction year over year. You can do a cost segregation study, pay somebody to do it. It will cost you $1,000, $2,000, $3,000 or whatever, depending on the type of property you have. But the cost segregation allow you to take your building, take the structure of your property and break it down to a 5-year, 15-year, 10-year depreciation, accelerated depreciation, so you can get more deductions on a year-over-year basis instead of do the slow 27.5 year straight line.
Right.
To advertise against the building. Does that make sense?
That makes sense. Yeah, definitely.
So
very good.
Yeah, segregation, cost segregation is anything that are not permanently attached to the structure. You can do a 15-year, 10-year, or 5-year depreciation, accelerated depreciation, and get much more tax benefit than you otherwise would get if you use a straight line 27.5 years on a 4 unit and 39 year straight line. Make sense?
Yeah. That makes sense. Yeah, that makes sense a lot.
Okay, again, the cost segregation, bonus depreciation, there are some tax rule. As you can see, in 2024, the IRS can only allow 60% deduction on the cost segregation, but there's a bill before the House and the Senate whereby they may revert back to 100% total depreciation on a cost segregation. So otherwise, if the Congress does not change the tax rule with respect to cost segregation, you can only deduct 60% of the bonus depreciation cost segregation this year. And then next year, only 40%, following year, 2026, only 20%. And then 2027, no more cost segregation, no more bonus depreciation.
Interesting.
Yeah, I believe when I talk to my licensed tax advisors from time to time, they believe they're gonna restore the 100% cost segregation.
Okay.
This year or the next year, and some investors, they can do a amended return to go back to the prior year and to redo the 100% depreciation, so they can capture more tax benefits from a prior year's tax return. So Keep that in mind. Okay. Again, just to summarize, cost segregation, bonus depreciation, 3, 5, 7, 10-year depreciation, acceleration, the write-off, instead of straight line 27 and a half. Okay. Again, we're using the same example. Okay. Anyway, any questions so far?
No, this is good information.
Again, since I'm not a licensed advisor, one might ask, if I do a cost segregation, if I get the 100% write-off and all that, what are, on this example of this fourplex, what are the net benefit? Okay. I'm using the scenario where here's my calculation. Again, this is just a approximation. It's not a precise cost segregation benefit. In this case, like is 38,000. How I figured that out? Because this is the cost basis for 36K.
Right.
You can,
Okay.
65% of the structure is permanent. You cannot do a cost segregation because they are attached to the property. Okay.
Okay.
65% of the cost basis is 283. 283 divided by 27.5 years, you will still get the $8,000 for the long-term straight line. But the cost segregation portion is the 153,000. Okay, the 5, 7, 10 to 15 years based on this case study. Then so you can do a cost seg around $28,000.
Okay. Okay.
So that's pretty good deal. Okay, so keep that in mind. Yeah, it's just a high level numbers. Okay, we went over this. Okay, by the way, so if you can get the $28,000 cost segregation instead of the $16,000 slow straight line 27.5 years, the bonus depreciation cost segregation allowance we just discussed give you double the passive losses, double the depreciation on. You can deduct on the current year that you did the cost seg. So just do the math. Your gross rent 64,800 minus the cost segregation you just did equals, instead of almost $12,000 of passive loss, you can deduct against the active income. You can deduct $24,000.
Oh my goodness.
Passive losses.
Wow.
After the cost segregation study. So this one property, this one fourplex of 545K, even if you make less than 150,000, right? Under the previous rule we discussed, the active investor rule, you get up to $25,000 maximum depreciation.
Okay.
Per year, if you make $100,000 or less. Simple. You can buy 5 rental property at $200,000 to achieve up to $25,000 depreciation for the current year. One fourplex income property. Okay.
Okay.
You got $24,000. So you max out the passive loss limitation just by buying one fourplex at 545K. So if you make $100,000 adjusted gross income reduced by this paper loss of $24,000, so your AGI subject to tax bracket, $100,000 minus 24 equal 75,000 or something like that. Instead of $100,000 subject to taxation, you have $75,000 of your adjusted gross income subject to taxation. So you reduce, you can have a tax refund or tax benefit of several $1,000s. That's tax savings. Not all of it, but a lot of it could be a down payment for your next income property.
There you go.
Like in Buffalo.
Good point. Very good point.
In the area that you bought.
That's it. Yeah.
Imagine that.
That's it. That's a very good point.
I'm not a licensed tax advisor, but I know how to explain things in layman's terms. That's the best way to understand something if you talk within the experience level of a typical mom and pop. So the next category is if you make more than $150,000. Okay, fine. That's great. Make a lot of money. If you make more than $150,000 adjusted gross income with all the depreciation, everything else, you can deduct all your debt service against your rental income, which is good. If you make more than $150K, it could only max out your passive losses against your passive income. So there's a lot of limitations, especially when you're not a real estate professional.
Yes.
But don't worry, because if you buy more rental property, I discussed the fourplex. If you buy more properties and you get high income cash flow that you get, the suspended passive losses, if you make more than 150K, the suspended accumulation passive losses can further reduce your rental income, your cash flow from your additional cash flow property you are buying.
Oh, okay.
So
Wow.
this is a very important topic.
Mhm.
So we talk about one property, you're getting $10,000 positive cash flow, right? After all the deduction. If you
Right.
buy more property, if you have the capital, that is, not everybody have money,
Right.
but a lot of
Right.
people still do. They have capital for the down payment to buy
Sure.
second, third, and fourth rental properties.
Right.
What if you buy several more rental properties and get $5,000 to $10,000 positive net positive annual cash flow? The net profit
There you go.
is subject to taxation, but if you make more than 150K, any suspended passive losses will be suspended to future years to offset against future passive income. That is the future benefit for people
Right.
with high income.
There you go.
Even if you are not a real estate professional tax rep status, okay? So
That's good. That's really good.
on your rental income schedule, look, okay, you can, if you buy 3 or 4 or 5 rentals in the next couple of years, cash flow rentals, there's
Sure.
an important distinction, okay? Right market and this and that, but, although we have those kind of products, so you document your, you file your tax return, right? Property A, property B, property C, then
Mhm.
property D, then you have positive cash flow. All
Right.
the suspended passive losses can be carried over to reduce your cash flow, your rental income from your other income property, where you can pay less taxes.
Mhm.
Even again, I have to repeat this. Is this the third or fourth time? Let me repeat this. From time to time over the years, my high income investors, they come to me, they say, see, Wayne, I'm not a real estate professional tax status right now. Maybe in the
Right.
future I will be. I do not make less than 100 grand, whereby you can deduct up to $25,000 passive losses, just that easy.
Mhm.
But if I make more than 150K, I get no depreciation. But you
Mhm.
are getting tax benefit.
Right.
Like I alluded to, let me be very clear. Sometimes people need to listen multiple times before something click in their brain.
Sure. Absolutely.
You make 150K or 200K, $300,000. You are not a real estate professional's tax status. We cannot offset your passive losses against active income, against depreciation income.
Right.
When you buy second, third, fourth income property, you're going to pay taxes on it. You could have high cash flow, even with the
Right.
deductions, even with the debt service deduction we talked about,
Right.
even without the depreciation limitation you have because you're a high income earner,
Mhm.
but the suspended passive losses with the cost segregation or no cost segregation into the future years, those chunk of passive losses you can carry through subsequent years can offset against the net cash flow from your other property. So your other property can benefit from
I
this
see what you're
chunk
saying.
of suspended future passive losses. At the end of the day, you're still paying less taxes because your rental income are further reduced by those passive loss carrying
Right.
forward previous years. And then you get the expense write-off on your mortgages, tax, insurance, property management,
Mhm.
vacancies, and travel expenses on top of the
Right.
suspended
Right.
losses to reduce the cash flow income that you receive from
Right.
your other income properties.
Wow.
You,
That's a win.
Julie, you get what I'm saying?
It's a lot to take in, but I got the foundation. It's like dealing with those passive losses, carrying those forward. And it almost sounds like the more properties you have, the more you're going to benefit from that strategy.
Exactly. You got it, Julie. You don't have to be a tax expert. You don't have to be good at numbers.
Right.
Conceptually, if you
There you
understand
go.
concepts, which you
Mhm.
do,
Right. Right.
you don't have
Right.
to be a college graduate to digest my presentation today.
Good point.
You don't even have to be a high school graduate. All you need is to have a common sense.
Right.
Real estate investing, tax strategies or otherwise, is not rocket science. I could say this in my lifetime investing career. If I were to tell you, although I grew up pretty poor in the ghettos of Philadelphia, okay, that's
Mhm.
fine. But
Mhm.
I was self-made myself, and I got a
Mhm.
bachelor's and master's, whatever. Knowing what I know right now, in the past 20 years of investing and guiding others, if I do not have my master's degree, if I didn't have my bachelor's degrees, I would still be able to be where I am without those academic.
Absolutely. Oh, I totally agree with that. I agree with that 100%.
I have investors who does not have a college degrees, who
Mhm.
not academically inclined. They work at a blue collar trade and they still doing investing. They are average American who have the motivation to buy income property through my help. I have some Silicon Valley. Most of my investors are Silicon Valley engineers and medical professionals in the Bay Area. They're making a huge amount of money. But anybody can digest
Oh, absolutely.
risk investing,
Absolutely.
including the tax strategy we discussed right now. So there's no
That's
excuse.
true. Yeah. And anything you don't understand, ask your tax advisor. Because I think what you've provided a really good foundation of information. But yeah, definitely take that strategy to your tax professional. If you already own property or if you're thinking about buying it, it's the best way to go. But you got to make a decision. You got to make a decision.
That's right. All the education, tax or otherwise, education without action is worthless. Totally
true.
worthless.
That's true. Yeah.
You can have all the education my members have been getting over the years, the daily email blast they get from the email inbox about all aspects of investing.
Right.
I could give out a PhD in real estate for all of my members based on the education and the content that I provide within my network.
That's true. Very, very true. Good point.
What's the purpose of having PhD in real estate if you do not own a freaking rental property at all?
There you go. There you go. Exactly.
It's pointless. Why waste your time wanting to become investors if you don't have the wherewithal and to buy real estate and wait instead of wait to buy real estate?
There you go. Fear transcends all economic background.
All right. I have achieved my own personal financial freedom years and years ago that allowed me to travel to multiple countries, more than 50 countries. I'm in a good place. If I could help one more investor to take action to achieve wealth, I have served my purpose in this life.
There you go. That's your mission, to really educate and help other people.
Yeah, I can only help so many. The holy grail of tax benefit is real estate professional status, otherwise known as reps. In the future, when you hear me say the word reps on our future podcasts, you know what I'm talking about. Real estate professional status, you don't have to be a licensed real estate agent. No, that got nothing to do with that. Although people misinterpret as such. All right, let's take a deep dive. So what type of risk investors are ideal to apply this reps strategy? Do you know?
Looks like high income earners? Yeah.
Doesn't have to be high income earner, but the ideal strategy to be a high income earner, W-2 or small, successful business owners, people making 100 grand, 150 grand, 300,000, 500,000, even $1 million of W-2. It could be doctors, business owners, management people, high level CEOs, people paying highest federal tax rate. I'm not sure exactly the current tax code, I'm a licensed tax advisor, but highest tax rate could be 37% federal tax bracket. Am I right or wrong?
That's correct. Yeah.
And for those,
yes.
Yeah. For those who live in California and New York State and other high state income tax states, additional 12%.
At least, yeah.
So technically speaking, the people that does not look into tax strategies, whether real estate or not, you don't have to buy a whole bunch of income property just to get high tax deduction. You can have other businesses. You can get into other passive income business, retail stores or syndications or whatever, achieve similar high tax benefits, not just income property owners using real estate professional tax status, right?
Correct. Correct.
But ideally, because when you're paying a lot of taxes, you need to buy a lot of, several rental properties in order to get the depreciation, in order to get high enough amount of depreciation to offset against the W-2 income. Am I right? Active and portfolio income. You have active income, W-2 or whatever. If you have portfolio income, dividend income, interest income, other IRA income withdrawals, all those portfolio and active W-2 income are part of what the IRS call as active income. So if you qualify as a real estate professional status, you could offset all those huge chunk of cost segregation bonuses or passive losses on your real estate portfolio against your active income, and you could potentially reduce your 37% federal tax bracket to 15 or even 10% or even 0%.
Oh, 0 is good. We like 0.
Yeah, some people can do it. They really have to digest
Mm-hmm.
the strategy, whether it makes sense for them, right? Not that many people qualify for it,
Mm-hmm.
but very few people qualify for it because they are not willing to do the work. The investors are not willing to get educated. They're not willing to, even with proper tax advice from a trusted tax licensed professional,
Mm-hmm.
even they qualify. Some people, you and I know, right? They are too lazy. They don't want to put in the effort. They
Right.
don't want to grind. They don't have commitment. They don't have proper dedication, the whole 9 yards, right?
Yeah. Yeah.
It takes a special
Exactly.
person to go this highest level of tax strategies, which is to become
Mhm.
a quote unquote real estate professional. IRS, believe it or not, they want you to be rich. They are giving you a lot of tax codes
Right.
allow you to benefit from.
Mm-hmm. Mm-hmm.
So the government is on your side.
Right.
Some people may not believe that, but the government, they have these rules and laws and tax regulation that can make you rich. Believe it or not.
Right.
So you have to think like this, but you have to know the rules, right? And don't practice any fraud. Don't do any illegal stuff. Follow the rules and hire a trusted tax advisor, which we have one. We have Keystone CPA within our network. Amanda
Mhm.
Han, which I
Okay.
did a tax podcast yesterday.
Oh, wonderful.
So Amanda Han and her partner, Matt McFarland, CPA from Keystone CPA, they are
Mhm.
our tax partners for our organization, our investment club.
Okay.
Yeah, we did a very nice tax.
Oh, good. I look forward to seeing that one.
Absolutely. Yeah, have to edit that. Yeah. Okay. Moving forward, this is the final topic we can discuss. I promise I told you this can be more than 1 hour. It's good. Okay. Okay. Here's a tax code, section 469 of the tax code, risk professional rule, unlimited passive activity uh, allowance, meaning unlimited loss deductions from rental real estate activities allowed to be offset against all other passive income. Okay,
Mhm.
using this rule. One thing to potentially zero out your W-2 income, which is amazing.
That's great.
Now, yeah, the rules, a lot of people, they are confused by it. And even experienced investors, like I told you, even experienced investors are confused by the rules. I don't know. It's just, anyway, I'll do the best to explain this. And other than that, one must hire a licensed tax advisor to go over the unique situations. At the end of the day, to qualify to achieve maximum tax benefit, so you can offset your passive losses, depreciation, cost, seg, bonus depreciation against active income, which is amazing. It'll unleash your tax benefit. But the best way to do it is you're married filing jointly. One spouse
Okay.
alone can qualify. Okay.
Right.
But you have to, the step 2 is you have to meet this rule. You have to meet
Yes.
150 hours in real property trade or business. This
Mhm.
is material participation. So 750 hours equate to 15 hours per week. But if you are by yourself, if you're single,
Mhm.
if you have a full-time job working 40 hours or whatever per
Right.
week, you cannot meet this test.
Right. Yeah, it makes
50%
sense.
of your total work time must be in a real property and trade. But
Mhm.
if you already have an existing full-time job, 40 hours or more per week,
Right.
you cannot add another 40 hours to make the 750-hour annual
Right.
hours possible. It's just
Exactly.
so
Mhm.
I
It's a
say it
good
again.
point. Good point.
Julia, I say it again.
Mhm.
Whether you're single or married filing jointly, if your non-working spouse or if your part-time spouse are not willing to become a real estate professional, and or if you are single, you are working full-time, making tons of money,
Right.
will not qualify for real estate professional status because you will not meet this 50% of total work time rule as I
Right.
alluded earlier. Make sense?
Yeah, that does make sense. Totally. Mhm.
So the ideal situation where one people work put that part-time or not working spouse to become a real estate investor, and do the 750 hours per year, which is
Right.
about 15 hours per week.
A week. Okay.
Okay. So therefore, if you're single, you might want to marry.
I love it.
When you go out and date someone, if whoever you are, whether you're male or female, one of the qualifying criteria for you to date someone is, are you willing to become a professional?
There you go. It'll tell you a lot about their goals for the future. Love it.
Again, it's all about documentation. You have to keep a log, right? Time log and all that. You have to keep a good record, because if you get audited, if you have no documentation to document your 15 hours per week or 750 hours per year,
Yep.
then you can lose the tax audit, and all the tax benefit you thought you claimed,
Mhm.
you have to pay it back to the IRS.
Yeah, they will be looking for it too.
Exactly.
Yes.
But again, some of my tax advisor network, they have they know how to do this for you, like Keystone CPA, for example, and very few, if any, of their clients who have claimed rep status ever get audited.
I love that. Wonderful.
That's right. You got to surround yourself with a trusted team of financial advisors,
Absolutely.
whether it's a tax accountant or asset protection attorneys or your realtors or your mentoring coach, like myself, or property managers. All those team members will make you rich over time. So am I right or am I wrong?
Absolutely. For sure.
Yeah. So I'm not going to go over the audit details. There are still 7 material participation rules and all that. But at the end of the day, then again, the 750 hours are very stringent, very strict. Is really material participation. Okay. It's
Right.
not just because you attend a seminar, just because you travel to visit your property, your potential properties, or attend a podcast. Those
Right.
hours are not really credible hours. They are not really material participation.
Right.
Material participation rule with respect to rep status, the 750 hours, are mainly you doing all this. You are directly or involved in all these aspects, meaning constructing, meeting with engineers, hiring, firing, fixing up your property, scheduling inspections, demolishing the property, meeting with salespeople, searching, looking for properties, making offers, arranging for financing, physically doing all those kind of things. Yeah. So, the keeping a documentation using to substantiate your loss, taxpayers, they lose an audit because they lack detailed, contemporaneous documentation log.
Yes.
Here's the end of the day. The people that can benefit mostly from risk professional rep status, the people who have very high income. And yeah, I've talked with people in my network, and I network with a lot of people all over the country for many years now.
Right.
Some tax advisors, they tell me a lot of their clients, they're doing rep status, they make like $500,000 W-2 income, $1 million. And they are doing all this stuff. They are out, and they are receiving massive amount of tax benefit.
Yes.
Here's the ideal situation, okay? It doesn't apply to anybody, okay? If an investor is too scared to do the rep status, if they don't want to the risk an IRS audit, and they don't have the money, to buy multiple properties to achieve high appreciation loss to offset against the active income, or people simply have a lot of high income, but they are scared to invest in real estate. Those people, they don't do it. They don't qualify. Anyway, so the ideal situation is purchase and scale your real estate portfolio with multiple properties. It doesn't have to be, you don't have to buy 2 or 3 properties at one time. Buy one at a time for every few months. If you have capital to buy more, if you consult your tax advisor, if you feel you qualify to become rep status, in addition to the normal depreciation, in addition to the normal deductions that we talked about, the deducted mortgage interest, taxes, insurance, those are deductions in the mortgage payment you're paying on income property. They are all the deductions against the gross income anyway. So on top of that, you're getting, if you can do a cost segregation on some of your property, not all, and do bonus depreciation, and furthermore, if you can do a short-term rental tax loophole on top of that to buy one or more property under this short-term rental somewhere in the country, if you can do this is the ideal scenario, and For example, the property you should buy, you have higher the value, higher the cash flow in a good market. A fourplex, duplex might work because your cost basis, your depreciation basis is high. You can get more deduction
Right.
out of it. Does it make sense?
That makes a lot of sense. Very good point.
In your situation, you bought some small price properties in the Midwest costing 60, 80 grand. The tax benefit are not that high. Those property, I don't think one should get a cost segregation and pay a cost segregation company
Oh, yeah.
$2,000, $3,000 to do a cost segregation on a low price property. But the net effect of tax benefit is less than the money you pay for the cost segregation study.
Exactly. Good point. Very good point.
Yeah. Again, the ideal portfolio is buy one fourplex in Texas, for example. In Florida, buy another fourplex for $800,000 or whatever. Buy another duplex somewhere in Alabama, or even buy a 6-unit apartment somewhere in the Midwest. That if you have this nice portfolio of properties, it's an ideal situation.
Absolutely. Absolutely.
See? Again, the rep status, real estate professional status, unlimited passive losses, offset against active income. So just do the number, right?
That was a lot of information, but it was all very good. And I think the advantage of being able to play it back and watch it is you can absorb the information at your level and what's important to you. So you've given 3 different strategies on way you can benefit passively from the passive tax losses. If you already have property or if you're thinking about property, they're all great strategies to look at and just really, again, run it by your tax advisor.
I'm happy that you're able to digest this information. It's not normal to hear this kind of technical information, but with a little bit of common sense, or anyone could digest it. And
Absolutely.
yeah, tax benefit is just one component of an income property. You and I discussed that numerous times, and we must bring this across every time we present any podcast. And we've been doing that. Again, the recap is this. Tax benefit is one of the at least 4 profit center associated with owning any rental property. That is cash flow, which is passive income increasing over time, and then appreciation, 3 to 5% appreciation over time. 10-year cycle, you will make money on your property, even though some negative people may not think so, because based on current real estate environment,
Right.
even the current real estate environment on an annual year-over-year basis in the past few years, real estate still continue to increase. Although the crash bros out there, they will say otherwise. But
Right.
for the purpose of clickbait and monetizing their channel, they are hurting a lot of people, right? A lot of people, they watch the negative news and destroys their brain. They become paralyzed.
Right.
When a human brain become paralyzed because they've been so systematized and their programming of negative information coming to their brain on a daily basis, they're promoted by those misleading crash bros that predict a housing crash every single year for the past 10 years. And every single year they've been wrong. Okay, so stay away from negative programming, those doom and gloom YouTube content creators destroying your financial freedom. If you subscribe to their channels, they will give you permission to do nothing.
Give yourself permission to do something.
Exactly. Julie, as always, you're perfect compliment for our podcast. You provide a lot of value. You are a representation of the typical mom and pop investors out there who's trying to make a difference for yourself.
Absolutely.
Who are giving the challenges and the volatility of the current housing market. You still continue to stay the course, invest for the long term, collect your cash flow. You don't care about the short-term volatility. Term, over time, historically speaking, 10-year or more, you will make money with your listed portfolio.
Oh, absolutely. For sure. 100%.
Yeah. Thank you so much, Julie.
All right. Thank you.
Your time. Thank you so much. Have a nice day, everyone. Oh, by the way, if you see any value from this topic, please like and subscribe and comment on my YouTube channel below, and then subscribe to my email below on my website, and you will become a free member of our real estate investing community. So you receive daily and weekly great free real estate investing content. Email inbox. Thank you so much for watching. To see you with Yi and Julie. Thank you. Have a nice day.
Thank you. Thank you again.
Thank you. Bye-bye.